Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel, and as part of our series to bring you different perspectives and ideas on investing, I wanted to share a video from Griffin on creating the perfect 3-fund portfolio of ETFs. Griffin has a great conversational style on his channel and some excellent ideas on investing. I'll leave a link to another video of his in the description below, so make sure you check that out.
Hey, thanks a lot for having me on your channel, Joseph. So in today's video, we're going to be speaking about how you can easily construct a 3 to 4 fund stock market portfolio using low-cost exchange-traded funds exclusively for healthy diversification along with nice portfolio passivity if that's what you're after as an investor. I'm definitely a big fan of using ETFs myself in my own portfolios, and I know that Joseph has also released quite a few videos speaking about exchange-traded funds on his channel. So for the modern retail investor, I really believe that properly utilizing ETFs for either a foundation to your portfolio or even a nice complement to certain core positions can be a very strategic way of building out a portfolio. Now, this type of 3-fund portfolio is perfect not only just for beginner investors, but also for pretty much anyone who's looking for greater diversity and exposure to other industries and companies without having to hold a bunch of individual stocks, which would entail having to keep track of all of these companies for more active portfolio management. And this is also the type of portfolio construction that is perfect to build out first as a foundational layer to your portfolio that's going to be more in line with your investor profile and desired asset allocation mix. And then from there, cherry picking some individual positions, maybe higher growth stocks or dividend stocks, can be more strategic to complement those core portfolio holdings. Over the past couple of years, exchange-traded funds have become extremely popular in the retail investing community, and for good reason. So without further ado, let's get right into it. But before, let's take a look at some elements that I consider when characterizing an ETF as a core holding. These are the ETFs I'm speaking about for first building out a solid foundation. Alright, so the first thing I look for in a core ETF would be diversified exposure to many positions. You want an ETF that has multiple different holdings in it so that your one investment is spread out across multiple different positions. Now, the second thing I look for is that the core ETF has to track a passively managed index that's at least 15 years old. That's sort of the baseline that I set out for myself. The next criteria is that the core ETF has to have a history of consistent earnings exceeding 7% annually, because this is the whole premise of a core holding. It's going to act as a foundational layer for both consistency in appreciation over time in your portfolio. Next up, the core ETF has to have a low management expense ratio, under 0.2% preferably. In the United States, you can get rock bottom expense ratios in the 0.04% range. Alright, so now that we have a better understanding of what we'll even categorize as being a core ETF, we need to first understand what your asset allocation mix will look like. Quite simply, asset allocation is the desired percentage that each asset within your portfolio will hold in relation to your investor profile. And this takes into account elements such as your age, your risk tolerance, along with your investment horizon. And it's really important that you actually give this step some thought, because this is essentially going to be the basis of how your portfolio will be constructed moving forward. And in respects to a 3-fund portfolio, this is essentially going to tell you how much you should be allocating to your equity ETFs versus your fixed income ETFs. Now, we won't get into a full discussion about determining your investor profile and therefore your asset allocation split, but what I would recommend doing as a preliminary exercise is asking yourself how tolerant to risk you are. This essentially means whether or not you're comfortable with larger fluctuations in portfolio value over the course of your investing, and therefore you would typically allocate a larger portion of your portfolio to equity positions over fixed income. From there, you also need to consider your age in relation to your investment horizon and ultimately what your goals are as an investor. The idea here is that with a longer investment horizon ahead of you, you essentially have more time to ride through the inevitable swings in the market and market cycles. So for this reason, if you have a longer investment horizon in front of you, you can therefore allocate a larger portion of the portfolio once again to equities. In this light, a younger investor who typically will have a higher risk tolerance along with a longer investment horizon in front of them will be able to allocate a higher portion of their portfolio to equity positions for higher average returns over time. So anyways, take the time to consider what we just spoke about and try to apply this as best as possible to your own situation. From here, I've prepared 3 model portfolios that you can use to base yourself off of, but make sure to only use these as inspiration. So the first one would be a more aggressive split where you may hold up to even 95% equity versus 5 or even 10% fixed income. From there, the second model portfolio would be a more balanced split, and in this case, I would allocate roughly 70-30 to equity positions. And then finally, a more conservative split may hold, say, a 50-50 split between equity and fixed income. Now, personally, I am a bit more biased towards equities and tend to focus a larger weight of the portfolio towards equity regardless of your investor profile, as I believe there's significant opportunity and options available to us in the market to generate income from equity positions also. By the way, if you want to learn more about some high dividend distributing ETFs and stocks, then I'd highly recommend you check out some of Joseph's videos. He has a bunch on the topic, and I also have a couple on my channel also. Alright, so at this point though, you should have a base understanding of your investor profile along with the asset allocation split that you'll be moving forward with. It's also at this point that you'll need to consider the elements that we spoke about previously regarding what constitutes a core ETF holding, because with the 3-fund portfolio, we're exclusively going to be using core ETFs first. With that said, let's cover a handful of core ETFs in the North American market, first starting with equity ETFs. Starting with the first and one of the most popular index funds, we have an S&P 500 ETF. Essentially, this is going to track the 500 largest companies in the American market. The S&P 500 is one of the most widely recognized indexes in the world. Most investors are familiar with it, and it essentially tracks, once again, the 500 largest American companies. This includes staples like Apple, Microsoft, Amazon, and now even Tesla. But the beauty with an index like this is that it constantly changes and gets updated to contain a weighted balance of these companies. And what this ends up producing over time are relatively steady and consistent returns for investors, even though not the flashiest investment, consistently and passively earning around 10% on your money for doing basically nothing is fantastic. And actually, over the past 10 years, take a look at the average returns that we've been experiencing with the S&P 500. This is a great return, especially for such a passive investment. Examples of ETFs that track the S&P 500 would include SPY or VOO in the American markets, along with VFV in the Canadian market. Now, if you're looking for more diversification within the American market, another great alternative would be a total US market ETF. This type of ETF will hold significantly more positions, thus a total US market ETF, and expose you to both small and medium cap stocks along with the larger cap stocks that would already be within the S&P 500. And then finally, the third and last core equity ETF that we'll be speaking about today would be a NASDAQ 100 ETF, which is somewhat similar to, say, the S&P 500. However, this is an ETF that is only going to track the 100 largest companies that trade on the NASDAQ exchange exclusively. This includes a higher number of companies that operate in the information technology industry just through the nature of what the NASDAQ is. So we've got the top companies being Apple, Microsoft, Amazon, Tesla, Facebook, Google, Nvidia. You get the picture. These are some of the largest and most influential companies in the world. Now, if we take a look at the average returns over the past 10 years of a NASDAQ 100 ETF, this one being the QQQ ETF offered by Invesco, well, it is quite evident where, average returns over the past 10 years is 20.18%. I mean, that's just crazy if you think of it. Yes, we've been in a bull market over 90% of this period, but still, that's some of the easiest money you can make from a passive investment. All right, now that we've spoken about some core equity ETFs, let's take a second to speak about some core fixed income options. So when first building out a 3-fund portfolio, I would tend to first focus on an aggregate bond index ETF, and there are many options to choose from, but let's remember the criteria here being that we want a low management expense ratio along with a holding that has a broader diversification to it. And so with an aggregate bond ETF, you're exposed to multiple different types of fixed income positions, including government along with corporate bonds, and then also short, medium, and long-term bonds. A great example in the Canadian market would be either the ZAG ETF offered by BMO or the VAB ETF offered by Vanguard. Down in the United States, some good options would include the AGG ETF offered by iShares or even the BND ETF offered by Vanguard. All of the above have rock bottom management expense ratios and will expose your holdings to thousands of positions. So that pretty much wraps it up for the basic construction of a 3 to 4 fund portfolio using ETFs exclusively. It honestly does not need to be all too complex, and for the level of passivity that this type of portfolio provides, along with the average returns over the past 10 years, this is a great way to build out a first portfolio. I really hope that this video gave you some additional value, and I'd like to thank Joseph once again for having me on his channel. If you aren't yet subscribed to him, definitely make sure to do so. He has fantastic financial content and information related to stock market investing and other financial topics.